Right.
It's not streamed yet, sir. I think it's a lag. Maybe 10, 20 seconds will be waiting.
Okay.
Right, sir. We are live.
Okay.
So, hi, everybody. This is Khusbu from SICASA. And yesterday we had a very beautiful session. Just 1 second. Yeah. Yesterday we had a very beautiful session deliberated by Murli, sir, where we discussed regarding the Ind AS 23, 7, 33, 10, and some bits and bits of Ind AS 103. So today's session will be, the session is going to be carried forward by Sir. Sir, the mic is all yours.
Yes.
Thank you.
Okay. So please keep your mobile on silent mode. Okay. Good afternoon to all of you. Say we were discussing in the last class about 4 accounting standards, Ind AS 23, 37, 33, 10, and towards the end we were taking up on to Ind AS 103. So by then I was just looking at one of the problems that we did in borrowing cost, and in our institute study material there was a problem that they had. So let me just check up. So this was the problem that we were doing. So institute study material, the same problem is there in book back. I think so they have just went wrong. So because there will always be a chance that people will go back and check up. Say out of 2 lakh specific borrowing, 1.5 years spent, and out of this 2 lakhs, 50,000, which has got to be taken up at 9%, but we have got to take it up by 6/12. In the institute, by mistake, they have taken it up as 10/12. Okay. So there you have got to be very careful with that. And in institute, they have mentioned this as 11.4375% with 4 decimals, whereas we have done it at 11.44%. Okay. And the other working I was just mentioning about 35,160, I went through that solution and why there was a difference. And this figure, see why we review is that at any point of time, reviewing is good. This is correct. This figure of 200,000, you can split that into 2, because one coming under specific borrowing, the other one coming under general borrowing. So into 6 by 12 and this being 6 by 12. So therefore, this will be 25,000. This will be 75,000. So the figure out of 350,000, specific borrowing is not 2 lakhs. Out of that, it is only 1.5 lakhs. And this figure will be 2 lakhs. Correct. So it is better that we review it. And 1.5 lakhs into 9%, this portion comes to 13,500. And this portion, instead of 1.5, it is 200,000 into 11.4. This comes to 22,880 plus 13,500. That will exactly match with this, with what we have discussed in the last class. So therefore, all items are in agreement. And today we shall proceed with 103. And under 103, let us just take up a few questions there in the AS 103. In the AS 103, yeah. See, smaller problem, I thought I will just take it up initially. In 103, we take up not only business combination, but even certain basic principles of consolidation also we will take it up. Under Ind AS 103, we will cover up for computation of goodwill and so on as in Ind AS 110. Goodwill on consolidation also we will take it up. Now, let us take up a problem where we have it on the screen. On May 1st, Donovan Company reported the following account balances: current assets 90,000, buildings and equipment net 220,000, total assets 310,000, liability 60,000, equity shares 150,000, retained earnings 100,000, total liabilities and equities 310,000. On 1st of May, Beasley paid 400,000 in stock. In stock, here it should not be misunderstood as inventory. This is about shares. Fair value for all assets and liabilities, which will cease to exist as a separate entity. In connection with the merger, Beasley incurred 15,000 in accounts payable for legal and accounting fees. Beasley also agreed to pay 75,000 to the former owners of Donovan contingent on meeting certain revenue goals during the following year. Beasley estimated the present value of its probability adjusted expected payment for the contingency at 20,000. In determining its offer, Beasley noted the following. Donovan holds a building with a fair value of 30,000 more than its book value. Donovan has developed unpatented technology appraised at 25,000, although it is not recorded in its financial records. Donovan had a research and development activity in process with an appraised fair value of 45,000. The project has not yet reached technological feasibility. Book values of Donovan current assets and liabilities approximate fair value. See, this is an ideal example for your objective type question. What should Beasley record as total liabilities incurred or assumed in connection with the Donovan merger? 15,000, 75,000, 95,000 and 150,000. Second question, how much would Beasley record as total assets acquired in the Donovan merger? 400, 420, 410, 480. What is the value of purchase consideration? 400, 475, 420 and 250. What is the value of total intangible assets? 25,000, 45,000, 70,000 and 140,000. See, now let us just, this sort of question is more likely a possibility in a main examination. See, when you say as objective type question is not like A, B, C, none of the above or all of the above. That sort of question will not be there. So instead of asking a 6 marks question or 8 marks question, so they might provide 4 such questions and each one will carry 2 marks or 1 mark as the case may be, depending upon the complexity level. So Donovan reported the following. Donovan is the vendor company, target company, right? And Beasley is purchasing company. And for all assets and liabilities would mean, so we understand the purchase consideration prima facie, we will take it up as 400 at this point of time, right? So where Donovan will not be there and all assets and liabilities will be taken over by Beasley. And 15,000 rupees they have spent for accounts payable and legal and accounting fees. So Ind AS 103 is not in favor of capitalizing the expenditure. Transactions are to be expensed. So therefore, as part of that, we will not have this 15,000 to be expensed. See, one of our questions carried about what is the value of purchase consideration? Is that 400 is the question. So next is it should have been 415, but they have not asked that question. So this 15,000 should not be taken up. Then they have agreed to pay 75,000 to the former owners if they meet certain revenue goals, and that figure of 75,000 shall be taken up or not. So on that count, so along with 400, there is also a chance that people might think that it could be 75. So 400 is not appropriate, 475 is not appropriate, and we also understand that any contingent consideration for which they have taken up the present value, estimated value, etc., and they have kept it at 20,000. So 400 plus 75 you have got to ignore. Take this to 20. Prima facie it looks 420 as right, but we cannot be ruling out the possibility until we go through as how they would have arrived at this number. So they would have arrived at this number by taking up equity shares and retained earnings at 250. So that is the net worth or equity of the vendor company is not the purchase consideration. So therefore, 420 is the purchase consideration. So in fact, this sort of questions, putting them in zigzag position on which you cannot have any role. So you need to be very careful. Value of purchase consideration is that. Okay. Then assets are to be taken up at fair value is what 103 is telling. So building is worth 30,000 more than the book value. So we understand that their assets, what you have, building and all that, to that you add 30,000. Correct. Then, because they have asked what could be the total assets, they are asking us to find out what could be the total liabilities. Here they are talking about what will be the total of intangible assets. So that 30,000 has got to be taken up. Donovan has developed unpatented technology appraised at 25,000, although it is not recorded in their financial records. So in DAS, 38 is communicating very clearly where only that research and development, once they attain the status of development stage, it can be capitalized. So all those items which were where they have got an unpatented technology, where it has got a worth to be sold, but self-generated intangible assets will not be recorded at all, even though it may be having some fair value upon sale. However, this sort of restriction is there only for the vendor company where they have developed it. But we do not have that restriction as far as the purchasing company is concerned. We are expected to add 25,000. So to that number, we will add 25,000. Then we do have similarly another item which they have said in-house R&D fair value of 75,000, 45,000. So people might always be having this doubt as whether this 45,000 should be inducted or not. So let me tell you, and I will identify through institute study material for you. So let me just pick it up, the relevant portion. What is that volume number? 103? 4. So in 4, in business combination, we do have a place where they discuss something about whether it should be taken up or not. Say I wanted to show you that particular page where they have reported that we should take into consideration. WhatsApp close பண்ணவா? கரெக்டா? அதுல எந்த பேஜ்ல வருது பாரு கோபால? So about contingent consideration, they have mentioned that it should be the fair value of the assets transferred should be measured at acquisition fair value. Any direct cost of should be recorded directly into P&L account and not to be recorded in purchase consideration. That is with regard to transaction cost. See, now let us just take up besides which illustration number? 18. Yeah. See, question number 18 in which they talk something about that. So here, I would like to take up from here. Thus, recognizing in-process research and development as an asset on acquisition applies different criteria to those which are required for internal projects. See, there is one rule for an acquiree and another rule for acquirer. So, as far as acquiree is concerned, this item should not be recognized. But when it comes for acquisition, this will be taken up. So, please understand the research cost of internal R&D may under no circumstances be capitalized as intangible asset, should be understood for the company which is initiating the internal R&D. Whereas the same will have a different approach as far as the acquirer is concerned. So please do not have this confusion. you are expected to take up as part of your asset as far as the purchasing company is concerned. So therefore, add to that 45,000. Correct. Please understand, this is a very, very important thing. You should understand. எவ்வளவு பேர் இருக்கா? So you understand that. So you understand one important thing in this particular case. They've just asked what is the total value of the assets. See how questions are there to trap students. I'm just telling you, you need to be ultra careful. Now let's just take up 310,000. Only assets we are expected to take up, not liabilities. The question is about on liabilities, assets, both they have asked. Both that they have asked. So, but total assets would mean we are going to be very careful. So, what is this number that you have? You have 100,000. Am I right? 30,000 plus 25,000 plus 45,000, 110,000. So, immediately our mind would just see that 410,000 is the answer. How the other numbers should have come? Other numbers should have just come 420,000 from purchase consideration, that initial purchase consideration. So all that had just come. So how 480,000 could be the number? See, as far as objective type question, MCQ questions are concerned, you need to be a little more careful. So total assets, see here there is no question of proportionate marks. Either you get it full or you don't get it full. If the same question were to be asked, please find out what is the total assets when they ask without objective type question. Imagine that 480 is the answer, but we would have done the work up to 410,000, where 70,000 not taken into consideration. We will come to that aspect later. So up to 410 would mean some 3 marks to 4 marks out of 6 marks they would be awarding. So how dangerous your MCQ would be unless you are 100% sure you will not be in a position to get that marks. So proportionate marks not possible when you have MCQ. Now, let me tell you, none of these items that we have identified so far could be correct. 410,000. So, where from this 70,000 is coming up? Here is a place where you are going to be knowing that goodwill will also be taken up as part of total assets. So, therefore, there is a need for us to find out goodwill. How do we find out this goodwill? So, we know that 410,000 minus 60,000. 410,000, how come? 310 plus 100 minus 60. All that put together, how much it comes to? 410 minus 60 is 350. Purchase consideration, we have conveyed it as 420. Therefore, you consider that more purchase consideration would mean the difference will be taken up as goodwill. 410,000 we have just taken up plus 70,000 goodwill. So answer is 480,000. So please be careful. These are all trap questions. Let me tell you, out of 100, 95 will go wrong. I'm just not telling you. Just like that, I've tested and I'm just communicating to you. So please be careful. So 480,000. So now in this process, let us know about other question also. What are the total intangible assets that you have? So here also we have a trap. So 25,000 is one, 45,000 is another one. So how the question is being coined, you see, 25,000. People who are having feeling, oh, 25,000 is to be recorded. So they will be selecting. Another person might feel 45,000 will be taken up. Then they will be ticking this one. So those who feel that both will be taken up and they will come to a conclusion as 70,000 and they forget to include goodwill there. So 140,000 is correct. Other items are all wrong because goodwill will be coming as part of intangible assets. So out of 4 questions that you have, We have answered to 1, 2, and 3. 3 questions we have answered. The first part of the question is what should be baseless record as total liabilities incurred or assumed in connection with Donovan merger. So here is a place where this 15,000 they have mentioned as accounts payable. So apart from our liabilities that we have in the balance sheet of 60,000, we have 15,000. So 60 plus 15, people might just take up. Initially 15 also they would be taking up. This 75,000 also they will be taking up. And there is another 75,000 that you have. So all that put together, it would result as 150,000 is what they will be having. Actually, it is not so. So in this particular case, the answer is 95,000. How come? So where even though this 15,000 you are expected to expense it, the journal entry when you pass, you will be debiting that to expenditure. Credit will be given to outstanding expenses. That is one liability that you have. This purchase consideration to the extent of payment to be made, contingency payable. Here it is 15,000, contingency payable 20,000 that you have, and we do have apart from that the original 60,000. So when you carry out outstanding liabilities, so all that put together that comes to 95,000. Say fairly a very simple question only, but it has got a lot of landmine there. So getting all these items right is one achievement. So either they will be giving this for 4 marks or for 6 marks for each 1.5, or maximum it could be for 8 marks. So it all depends on the complexity and the placement of other areas. So mark it out as very important. There is one more, I thought I will just let you know in this particular category. So now let us just try that. Question number 5. On July 1st, True Data company issues 10,000 shares of its common stock, that is equity shares, right, with 5 rupee par value and 40 rupees fair value in exchange of all WebStart company's outstanding voting shares. WebStart's pre-combination book and fair value are shown below with book values of True Data accounts. So they have just given you revenues from 1st of January to 1st of July. So also the expenses. So do not have these figures in the negative. Don't feel that they are all in the negatives. Actually, if you look into all the liability side or credit side items, they are all in the negative. All expenses, debit and assets are all shown without brackets. That's all. So expenses 170 and 80, retained earnings on 1st of January 130 and 150, cash and receivables 140, 60, inventory 170, 190, 145 there, 175, patented technology net 230, 180 and 200, land 400, 200, 225, building and equipment 175 and 75, liabilities 540, 360 and 350, equity shares 370, security premium 10 and 30. Question number 1. So from this question number 5, we have 1, 2, 3 and 4 sub questions that you have, right? So what is the first part of the question? On its acquisition date, consolidated balance sheet, what amount should True Data report as goodwill? So they are asking us to find out what is the goodwill value. So how do we find out the goodwill value? Goodwill is equal to purchase consideration minus fair value of net assets of vendor company or subsidiary company as the case may be, right? In this case, they have mentioned as 10,000 shares and each share at 40. So 10,000 into 40, purchase consideration is equal to 400,000 rupees. Correct? So this we have got. The next item that we require is fair value of the net assets of the vendor company, and vendor company is Webstat, where they have given book value and the fair value. We are expected to take up only the fair value. So take into consideration 60,000 towards cash and receivables, where there will be, or where you find no change, 175,000 for inventory, patented technology 200, land 225, building and equipment 75, and we have liabilities being 350. Take your calculator and sum up all this and get me the value. What's the number that you get? Let me take the calculator. So 60 plus 175 plus 200 plus 225 plus 75 minus 350, it comes to 385,000. So 385,000, and we do not have any deferred payment or contingent consideration. So therefore, purchase consideration is more than the net assets at fair value, resulting in a goodwill of 15,000. 15,000 is correct. On its acquisition date consolidated balance sheet, what amount should true data report as patented technology net? We have got to be very careful. So the question is about patented technology figure. So please be careful whether they are asking about the taken over patented asset or only the purchasing company's patented or both. So the question is about a very clear question. So on its acquisition date consolidated balance sheet is what they asked. So on the date of acquisition, when they prepare consolidated balance sheet, they are expected to take into consideration 230 and 200 both put together. It should be 430. Is that clear? So they have just given you, people might be trapped and they may be looking into the fair value of the vendor company, that they will be taking it up as 200. Some people might take it up only for the purchasing company as 230, and the sum of the book values of these two entities coming to 410, and 430 is the appropriate number. So even when a person is just doing this exercise of fixing up MCQ, the other possible answers also he should visualize and fix it up. So a very nice way of fixing it up that way. Next question, on its acquisition date consolidated balance sheet, what amount should true data report as equity shares? So already the company was reporting prior to that as 300,000, and now 10,000 shares having a face value of 5 would mean, so 10,000 into 5, 50,000, and 300 already that you have. So thereby it is 350,000, fairly a very simple one only. And then on the acquisition date consolidated balance sheet, what amount true data report as retained earnings on July 1st. So please be careful. Here the date on which they are doing is 1st of July. So on this date, what is the retained earnings? True data will be reporting. True data is reporting. How much is that? So here you would be finding this particular companies, because the retained earnings of the vendor company cannot be taken up, because we are giving purchase consideration. Any earnings after acquisition will be the purchasing company's net earning. So in this particular case, 250,000 being revenue and expenditure being 170,000, there you have 80,000 as retained earnings, that is net income, with retained earnings of 130, both put together 80 plus 130, which is going to be 210. Okay. So no portion of the vendor company's profit this company can take up. So answer to this particular question is 210. Is that right? So all other possible answers are not appropriate at all. So You should not be thinking too much and waste time. And at the same time, you should not be careless or reckless in ignoring material things. So please be careful. Mark these sort of problems as very, very important. And now let us just proceed to other areas. So in the last class, I was just referring about things like merger, demerger, acquisition, and reverse acquisition. So we do have accounting, we do have legal acquirer, and the legal acquirer will become acquiree in substance. We will take up a problem, and from that problem, definitely we find from institute study material itself a lot of such beautiful questions that they have given. So now I would like to take up that particular question, that being in book back. I mean, end of the chapter questions. Page number under. Yeah. So I would be very happy to take up now. Question number 2. This is about reverse acquisition. So problem solving with a lot of numbers going would mean in a fast track, we would be finding it a little challenging, but at the same time, I wanted to try very important problems for the examination. So it is question number 2 on 31st of December X1. See, let me tell you a top class secret to you. The institute is picking up questions only from institute study material. Okay. On 31st of December X1, entity issues 2.5 shares in exchange for each ordinary shares of B. All of entity B's shareholders exchange their shares in entity B. Therefore, entity A issues 150 ordinary shares in exchange for all 60 ordinary shares of entity B. The fair value of each ordinary share of entity B at 31st of December X1 is rupees 40. The quoted market price of entity A's ordinary shares at that date is 16. The fair value of entity A's identifiable assets and liabilities at 31st of December X1 are the same as their carrying amounts except for the fair value of entity A's non-current assets at 31st of December X1 is 150,000. Sorry, 1,500. The balance sheet of entity A and B immediately before the business combination are, so here they mention legal parent accounting acquiring. Entity B legal subsidiary, but it is the real, there is accounting acquirer. We will explain this matter right at the very initial stage itself. So instead of going through these items, let us just explain this particular matter. So for that, we require the number of shares of these two companies. So at the very initial stage, they have mentioned entity A issues 2.5 shares for each ordinary shares of entity B. So now let us just take up this. We have chosen this particular question to have good amount of discussion in this fast track so that you have adequate practice before going to the examination. So this is book back on India's 103. So company A is issuing to company B. So now I would just say number of equity shares in B. Number of equity shares in B by going through the matter, there is the balance sheet which is coming to 60. 60 ordinary shares that you have, right? And what is the exchange ratio? Exchange ratio is 2.5 shares for 1. So number of equity shares in A to be issued. To be issued, it would be 60 into 2.5 divided by 1. How much it works out to? It works out to 150. So number of equity shares in A already held by shareholders of A. How much is that you have? We understand that they are having only 100. Now, what will be the total number of equity shares in merged entity? In merged entity, their number will be 250. See, now look into the percentage of holding. If this is 100, you just find this is going to be 60 and this is going to be 40. How come 150 upon 250 and 100 upon 250? So now, who will be the majority shareholders? Majority shareholders will be the shareholders of B in the merged entity. So apparently, A is the buyer, A is the buying entity, A is the buying entity, and the shareholders of A is reduced to 40% in merged entity. Correct? What is that? A is the buying entity and the shareholders of A is reduced to 40% in the merged entity. In the merged entity. And these people have become non-controlling interest holders. And those who have come, that is shareholders of B in the merged entity are holding 60%. So therefore, who is dominant now? So shareholders of B are vendor company shareholders. Now they have become controller. So therefore, we call this scenario in this fashion. What is that we are calling in this fashion? A is the legal buyer. B is the legal vendor. Now A lost control. B gained control. Correct? Those who are holding more than 50% will be having the control. That being the reason, as in the top itself they have written. What is that they have written? Entity B, legal parent, but accounting acquiry. Now they have become a vendor like. Entity B, legally they are a subsidiary, but accounting wise, they are the accounting acquirer. Are you clear about this one? This is very, very important. So whenever you read with a little amount of importance and check it up at each stage, because you can't be spending too much of a time. You go prepared for all this. So current assets, total non-current assets, total assets, current liabilities, non-current liabilities, total liabilities given, shareholders equity they have given, and retained earnings being 800 and 1400, and equity capital 300 and 600 given, total shareholders equity 1100 and 2000, total liabilities and shareholders equity 1800 and 3700. Okay. Assume that entity B's earning for the annual period ended 31st of March X1 were 600, and that of consolidated earnings of the annual period ended 31st of March X2 were 800. Assume also there was no change in the number of equity shares, ordinary shares issued by B during the annual period ended 31st of March X1 and during the period from 1st January X1 to the date of the reverse acquisition on 31st of December. Question is not a very great amount. Calculate the fair value of the consideration transferred measure, that is consideration transferred measure goodwill. Calculate the fair value of the consideration transferred measure goodwill and prepare consolidated balance sheet. as on 31st of December X1. So I just don't want to put the numbers in place. Just I wanted to tell what is a reverse merger. Apparently, which company is considered to be a buying company, in fact, it would have been sold the entity. Apparently, the company which was giving the impression that it is selling, in fact, it bought, retained the control. Now, look into the answer there. We have it in the end of the chapter. Whatever I've just conveyed, that is what you find that they have explained all this. Correct? How the goodwill has got to be measured. So consideration effectively transferred is 1600. How this 1600 we would have got it? Now let us just go for computation. So we all know that 2.5 as the share, and this particular page I have used to explain as what is reverse acquisition and all that. Now let us just take up the purchase consideration computation. Purchase consideration, where it is 150 shares multiplied by, so they have mentioned that the fair value of each share of entity B is 40. The quoted market price of entity A's ordinary share is 16. Now tell me what is a purchase consideration. So 150 multiplied by 16. So it comes to 2400. So we find, as I told you that I don't want to engage in computation, rather I will enable you to work out the answer in this particular fashion. So right at the very initial stage, I will just read out, as a result of entity A issuing 150 ordinary shares, entity B shareholders own 60% of the issued shares of the combined entity. This is what I've just shown you initially. The remaining 40% are owned by entity A's shareholders. Thus, the transaction determined to be reverse acquisition, in which entity B is identified as accounting acquirer, while entity A is the legal acquirer. So have that in your mind. So we have not yet come to that computation of purchase consideration. Closely follow. Calculating the fair value of the consideration transferred. If the business combination has taken the form of entity B issuing additional ordinary shares to entity A shareholder in exchange for the ordinary shares in entity A, entity B would have to issue 40 shares for the ratio of ownership interest in the combined entity to be the same. So what they are telling is that though you just find company A will continue to be there and company B is no longer there in existence, but we are expected to support the form or the substance when a question is asked. We are expected to support only the substance but not the form. What would have been if B were to be the buyer and A were to be the vendor? If that be the case, how the purchase consideration has got to be computed? This is what you find as an apparent purchase consideration. What is an apparent purchase consideration? What you see as 150 shares, and the shares are issued at the rate of 16. I will just show you. That is, we have to roll back to that particular page. So they have mentioned that the quoted price of A is 16. Correct? This is the way we will normally be doing. But what is that we are expected to do in reality? Now let us just look at the solution. Because many times students used to tell that, sir, we are not in a position to understand the solution given by the institute. So now you can understand what is that reverse acquisition and how it is to be computed. Okay. So if the business combination had taken the form of B issuing additional ordinary shares to A in exchange for their ordinary shares in entity A, B would have to issue 40 shares for the ratio of ownership of interest in the combined entity to the same. So imagine that whatever they were holding previously, if that were to be 60, how many shares that they are expected to issue for the shareholders of A? Because in substance, this is apparent, but what is latent? Latent is number of equity shares of B to be issued. B to be issued is going to be 40. How come 40? If B's existing equity shares were to be 60, representing 60%, how many number of shares that they got to issue for their 40%? 40 shares. And we are expected to multiply with the fair value of each share of B. Correct? So the fair value of each share of B is 40. That becomes 1600. That becomes 1600. Correct? That is the way we have just got this number as 1600. So prima facie, it looks like 2400 as the answer, but it is not so. You got to be very careful. So in the under examination conditions, this question could be planted there in the question paper, and they may be asking what is the purchase consideration in the above case. They may be giving 2400, 1600, and some other two numbers, dummy numbers, but chances of selecting that they will always be keeping in mind. They will not be giving some unconnected random numbers. You have to be very careful. Now you find 1600 whose net assets that we are expected to take up, not the net assets of B, but the net assets of A. So net assets of A should be taken into consideration. That is why they have reported net recognized value of A's identifiable assets and liabilities. So current assets, non-current assets, current liabilities, non-current liabilities. So where from we have to pick up? We have to pick it up from, we will just pick it up from here. We will pick it up from here. So see that current assets, non-current assets, current liabilities and non-current liabilities. 1800 minus 700. So 1100 will be your answer. Correct? Of course, there were some changes in the value of assets that you have mentioned that we should take up. So let me just tell you. $110. Under that, one non-current asset has got to be taken up at 1500. So instead of 1300, 1500 is what we are going to take up. So therefore, total assets would be 2000. 2000 minus 700. 1300 will be your number. 1300 will be your number. 122. 1300 will be the number, and a purchase consideration as I conveyed to you in this computation, and thereby we have a goodwill to the extent of 300. Purchase consideration minus the fair value of the net assets coming to 300. What were the questions that they asked? question what they asked being consideration, transport, measure goodwill. Now that goodwill is known to you, 1600 minus 1300 is 300. Then what is that balance sheet that we are expected to prepare? Simple only. So 1300 is over. What are the items that you will be taking up? Current assets, same value, no change in the value. Whereas non-current assets, instead of 1300, we have to pick it up at 1500, the fair value. And the goodwill resulted on acquisition, totaling up to 6000. Current liabilities, simply you got to add, no change. Non-current assets, simply you got to add, no change. And we have 250 equity shares. So you know how that 250 equity shares had just come. So they have just given 600 and 1600 and retained earnings as you find in the case of B and totaling up to 6000. So these are the ways through which you got to take up. Mark this problem as very, very, very important for you in the main examination. So without trying out this problem, do not venture for the examination. So market order is very important. Okay. Now, that is one such problem which I thought I will tell you. Now, question number 1, look back question, which I would like to try. This is also to be marked out as very, very important. In, say, I will tell you in this fashion, do not take any chance in 1 or 3. Solve all the problems. After all, you know pretty well that it is going to come. What is the problem in, there is no uncertainty here. I am telling you with certainty that one of the problems from institute material, they will be asking what is the problem in solving all the problems and being ready. Now let's just take up on to question number 1. So very important problems in fast track can be done. Not all problems, but definitely very important ones. When you are doing it, it becomes, when you try important problems, you feel really confident. Even if there were to be some change, twist and all that, you will be in a position to manage. So don't worry. Company A and Company B are in power business. Company A holds 25% of equity shares of Company B. On 1st November, Company A obtains control of Company B when it acquires a further 65% of Company B shares, thereby resulting in a total holding of 90%. The acquisition had the following features. Consideration. Company A transfers cash of 59,000 and issues 100,000 shares on 1st of November. The market price of Company A shares on the date of issue is 10 per share. Contingent consideration. Company A agrees to pay additional consideration of 700,000 if the cumulative profit of Company B exceeds 7 million over the next 2 years. At the acquisition date, it is not considered probable that the extra consideration will be paid. The fair value of the contingent consideration is determined to be 300,000 at the acquisition date. Transaction cost. Company A pays acquisition related cost 100,000. Non-controlling interest NCI. The fair value of the NCI is determined to be 750,000 at the acquisition date based on market prices. Company A elects to measure non-controlling interest at fair value for this transaction. Previously held non-controlling equity interest, Company A has owned 25% of the shares in B for several years. At November 1st, the investment is included in Company A's consolidated balance sheet at 600,000, accounted for using the equity method. The fair value is 2 million. The fair value of Company B's identifiable assets on 1st of November is 6 million, determined in accordance with Ind AS 103. Determine the accounting under acquisition method for the business combination by Company A. Now let's just go a little in a detailed fashion. Number one, company A and company B are in power business and A is holding already 25% in B. That means A is having substantial interest. Sorry, A is having significant influence on B. A is having significant influence on B. On 1st November, A acquires control. How come? They got 65% in the on this date. Earlier 25% plus 65% making up to 90% is given in the first paragraph. So they have crossed the threshold 50% on 1st of November. So date of acquisition is 1st of November. The consideration that indicated on 1st of November in that particular paragraph of consideration is 59 lakhs. 59 lakhs is purchase consideration number 1, which is purchase consideration number 1. Which number 1? Purchase consideration number 1, 59 lakhs. Purchase consideration number 2, contingent consideration, additional consideration. They said that they will be paying 700,000 over the next 2 years. Sorry, will be paid additionally if they achieve cumulative profit is 70 lakhs over 2 years period. Whether they will achieve or not, we do not know. At the same time, the additional consideration of 700,000 we cannot take up. So on the date of acquisition, date of acquiring the control, the value for such additional consideration is 300,000. So purchase consideration is 300,000. So the first consideration is only the cash consideration we have taken up. We have forgotten to take up cash consideration. Let me just take up that. So issues 100 shares and the market price of company A share is 10. So it is 1 lakh into 10, 10 lakhs. Correct? I forgotten. So I'm just taking up purchase consideration 1, purchase consideration 2, purchase consideration 3, transaction cost 4. How much is the sum? We are expected to take up 100,000. So if anybody is to take up that, I am just warning you not to take. Only for that I have just written, and you might even be thinking that sir is forgettingly writing it. No, not like that. I wanted to tell you not to take, so therefore I have written it and put a into mark so that you will never have any doubt under examination condition as what treatment you have got to bring in. So you are not supposed to take. Is that clear? Always, that is my style of doing things. That is what we have got to do. So now, when you have just done all this, whatever you have done is only for your 90%. Correct? This is for your 90% that you are doing, or in fact, this you are paying it only for 65%. Correct? The earlier purchase consideration that you already made earlier, so that is what you have previously held a non-controlling interest of 25% and consolidated balance sheet 600,000 using equity method and all that, they are telling that is to be ignored. On the date of acquiring control, how much value that you would assign for your previous holding, that 25% you have to take up. This comes to 25% and cumulatively this comes to 90%. The question is all about finding out determine the accounting under acquisition method is what they have just communicated. That means we are expected to find out goodwill. So up to this 59 plus 10, 69, 69 plus 3, 72, and this being 92,000, 92 hundred thousands or 92 lakhs. 92, that is 9.2 million. Non-controlling interest, the fair value of the non-controlling interest is determined to be 7.5 on the date of acquisition based on market price. See, as far as the non-controlling interest is concerned, that there are two methods that you have. One is fair value. The other one is based on net assets value, net assets taken at fair value. So this is fair value based on shares, whereas this is the proportionate pro rata value on the net assets. Such net assets are taken up at fair value. Don't get confused. So many a times people just do not read it properly. Fair value is on the shares held by non-controlling interest. The other one is it is taken up at a proportionate value of the net assets, where net assets are taken up at fair value. In this problem, they have clearly mentioned that it is to be done at fair value of the shares held, 750,000. So therefore, 100% of that comes to 99 lakhs and 50,000. It is short of 50,000 to a crore of rupees. Now, against this 100% of the net asset value, we need to know, and which is given in the problem as 60 lakhs. So therefore, the difference is going to be taken up as goodwill, 39 lakhs and 50,000. So in these cases, one important assumption that I got to make, deferred taxation ignored. Correct? Without fail, you have to make a mention that deferred taxation is ignored. So similar looking problem when you have with deferred taxation given, you got to be very careful in handling the effect of the changes in the fair value of the net assets, which will be taken up into fair value. That is, which will be taken into your deferred taxation. Changes in the fair value of the net assets and its impact on deferred taxation, we have to take up. Let me repeat. When assets are taken up higher or lower than the carrying amounts, these items for which we are expected to create deferred tax liability or deferred tax asset, as the case may be, that has got to be accounted alongside of the acquisition. But there is only one place on which you will not have that done, that is for the resulting goodwill or bargain purchases. Okay, that will not be taken up for goodwill or bargain purchases. So once you start doing it, no, so then we will be having something similar to that of what we have as circular reference that we have it in Excel. So you cannot just stop. So therefore, there is a prohibition imposed that we are not supposed to take up deferred taxation on resulting goodwill or bargain purchases in business combination. So you got to be very careful. Now let's know about the final answer here. Let's just check up. I hope that this point is clear for you. So 39 lakhs and 50,000 as the answer, and that is the way they would have just given. So I would just say it is not a difficult question, but we will definitely have a lot of points for discussion. Okay. So on the same lines, I would like to try a problem, something on the same business combination with deferred taxation. Let me take up that. For a moment, I will stop sharing, and after identifying the institute study material, I will share the screen. Now I will stop. See, I would like to switch our attention. Uh, Now I will share the screen. So this is illustration number 3, which is coming up as part of Ind AS 12. Okay. Illustration number 3. It is not book back, it is illustration number 3. Something very close to what we have just discussed, you do have here. Market order is very important. See, whatever problems that we are doing, market order is very important. We are not just doing it for time pass. We are doing it with a greater consciousness of getting the concept in a very simple and lucid manner. On 1st of April, X1, A Limited acquired 12 crore shares representing 80% stake in B Limited by means of a cash payment of 25 crores. It is a group policy to value the non-controlling interest in subsidiaries at the date of acquisition at fair value. That means fair value means on shares. The market value of an equity share in B or at 1st of April, X1 can be used. That one is ₹2. On 1st of April, the individual financial statements of B Limited showed the net assets at 323 crores. The directors of A Limited carried out a fair value exercise to measure the identifiable assets and liabilities of B Limited at 1st of April X1. The following matters emerged. Property having a carrying value of 15 crores at 1st of April X1 has an estimated market value of 18 crores. So 3 crores extra value that you have. Plant and equipment having a carrying value of 1 crore at 1st of April X1 has an estimated value. I think there is one typographical error that you have. So I do not know the present day figure. This plant and equipment having a carrying value of 10 crores is what I understand. Kindly make the correction, because I remember that after solving the problem, the institute went on to say that there was a difference to the extent of 3 crores only. Let me just find out. Yes. So plant and equipment is not even 10 crore, it is 11 crores. Extremely sorry, it is 11 crores. Plant and equipment having a carrying value of 11 crores on 1st of April X1 had an estimated market value of 13 crores on that date. So make that correction. Inventory in the books. See, when institute is printing out, lifting the same question, There may be a chance that without correction, they might just do that. So please be careful. Inventory in the books of B Limited is shown at a cost of 2.5 crores. The fair value of the inventory on the acquisition date is 3 crores. Inventory is upward valued by 0.5 crores. The fair value adjustment have not been reflected in the individual financial statements of B Limited. In the consolidated financial statement, the fair value adjustment will be regarded as temporary difference for the purpose of computing deferred taxation. The rate of deferred taxation, the rate of deferred tax to apply to temporary difference is 20%. Calculate the deferred tax impact on above and calculate goodwill arising on acquisition of B Limited. So you have got to be very careful. Now let's just take it up. Illustration 3 in Ind AS 12. Right. Now let us just try. Number 1. A Limited acquired 12 crore shares in B Limited by means of a cash payment of 25%, 85%, 25 crores. And the remaining 15% for non-controlling interest. If 12 crores were to be considered as 85%, how much is that 15% you will end up with? You may use the calculator because and then you got to multiply with fair value. 12 divided by 0.85, 0.15. One moment. Sorry, it's not 85, it is 80. Extremely sorry. Extremely sorry. From where I just got 85, I do not know. 12 divided by 0.8 into 0.2. Now it is going to be 3 crore multiplied by 2 per share. 6 crore. Correct? If 80% were to be paid at the rate of 25 crores, 20% has got to be valued with 6 crores. 31 crores. Right. Then net assets with 23 crores. Net assets with 23 crores. This is carrying amount. On account of change in property. Change in property, 3 crores. 18 minus 14. Next one, plant and equipment, 11 and 13. Inventory, 0.5. Then we are expected to take up change in deferred tax liability. How much is that? On 5.5 crores. These three items coming to 5.5 crores multiplied by 25%. Sorry, 20%. So that comes to 1.1 crore deferred tax liability we have got to take up. So people might just be wondering, sir, how do you know beforehand that it is deferred tax liability and not deferred tax asset? So all of you please understand, in the balance sheet when we prepare, the asset side is up by 5.5 crores. So we follow balance sheet approach for identifying whether it will result in DTA or DTL. When it is on the asset side, when it is up, to balance sheet, we have got to increase our thing on the liability side, not for 5.5. It is not about the number. It is about asset is going up, so naturally I got to create liability. So if the assets values are to be down, so when it is down, either I got to reduce the liability or I got to increase the asset. So there I got to increase the asset. So that's a very simple process only. So therefore we can identify that in this process. So now let us just know about all these numbers. So 23 plus 3 plus 2 plus 0.5 minus 1.1. How much it comes to? 23 plus 5.5 minus 1.1. That comes to 27.4. So that has got to be compared with 31. That would result in a goodwill to the extent of 3.6 crores. So the journal entry which has got to be passed for this particular purpose would be debit property ₹15 crores, because so in fact actually it is like this way. To net assets 23 crores, because they started with 23, no. Then debit further on to property. We do not know the components of net assets. So debit property 3 crores, debit plant and equipment 2 crores, debit inventory for 0.5 crores, debit goodwill 3.6 crores, credit deferred tax liability 1.1, credit non-controlling interest 6 crores, and credit cash 25 crores. Correct? So cash is paid is what they have mentioned, I hope. Because they've said cash payment to the extent of 25 crores. So the total of your assets, I mean the debits and total of credits should match. 23 plus 3 plus 2 plus 0.5 plus 3.6. 32.1. Here the sum of that is 32.1. Now let's just check up and find out 3.6 crores. Right? That is the way we are expected to do. So on to this goodwill, if you start doing this deferred tax liability, 20% of that is going to be 0.72. And when you are booking 0.72 here, to that extent of 0.72, once again I will add to 3.6. For that 0.72, I got to create once again deferred tax liability. So this way, an unending process will continue to be there, and in order to avoid that sort of scenario, they have prohibited, and they have mentioned it so clearly that deferred tax liability arising on account of business combination cannot be taken up at all. That is an exclusive prohibition that we do have. So now let's just go through that particular paragraph where they've said deferred tax arising from a business combination. As discussed about temporary differences may arise in a business combination. In accordance with 103, an entity recognizes any resulting deferred tax asset to the extent that they meet the recognition criteria, or deferred tax liability as identifiable assets and liabilities on the acquisition date. Consequently, those deferred tax assets and deferred tax liability affect the amount of goodwill or the bargain purchases gain the entity recognizes. However, in accordance with Ind AS, in certain circumstances, an entity does not recognize deferred tax liabilities arising from the initial recognition of goodwill. They have mentioned it so clearly. So, therefore, there is a prohibition. You are not expected to consider the deferred tax liability arising out of goodwill in the case of business combination. Correct? So once again, they have just communicated the subject matter. As a result of business combination, the probability of pre-acquisition deferred tax would change. All that they just went on to communicate this matter. Is that right? Are you clear about this one? Certainly, I know that you people will be very much happy with this particular problem. So market order is very important. See, now we will take up on to one particular problem which could be very easily you can knock it off, that being question number 5 in book back on Ind AS 12 alongside of 103. Don't get the impression that we are jumping from 103 to 112 12, not 112, it is 12. Ind AS 12. A Limited acquired B Limited. The following assets and liabilities are acquired in a business combination. Plant and equipment fair value 250, carrying amount 260, temporary difference in the negative 10. Inventory fair value 120 and carrying amount is 125, negative 5. Debtors 200, 210 and this resulted in negative 10. 570, 595, 9% debenture, 100 in both cases, 470, 495. Consideration paid 500 and 500 and goodwill there to the extent there being 30 and 5 negative 25. Calculate deferred tax asset. In what way this problem is connected to the last problem that we have worked? We are very fortunate with illustration number 3 where all assets resulted in appreciation, resulted in deferred tax liability creation. In this particular case, all these temporary differences resulted in reduced figure when compared to carrying amount. So therefore, in this particular case, we will have deferred tax asset. So just because the rate is not given, you cannot be just simply putting a note, rate is not given, so hence we are not doing it. Then they will not be awarding marks. So take 20%, 25%, 30%, whatever rate that you feel like that it is appropriate and work it out. They have not asked a journal entry and all that. You are expected to arrive at calculate deferred tax asset only. On 25, you apply 20%, you get 5. So in this particular case, this will result in deferred tax asset C5 on the assumption that the rate of taxation is 20%. Is that right? So just quickly, you can just knock it off. Let us just go through and find out. What is that they have just mentioned? Here, they have assumed the rate as 30%. No big deal. So here they have assumed in this particular problem as 30% and the number instead of taking up 5, it is 7.5. In fact, they have passed a journal entry to that effect. What is a journal entry that they have passed to that effect? Plant and equipment at fair value, inventory also at fair value, debtors also at fair value, goodwill, the difference you have to take it up. That difference, whatever they have mentioned, minus this particular deferred tax asset of 7.5, when you take up it is 22.5, 9% debentures and bank 500. So mark this one as very important. Not that it is very difficult. Whenever we say as important, it is not that it is difficult one. Concept wise, you got to know, and therefore I wanted you people to know about this. Right. Now, at this moment, it is 1.5 hours from the start. We have done two MCQ, one full-fledged, and two problems. So 5 questions we have handled. 5 questions we have handled on business combination alongside of deferred taxation effect. That is what I told you. And always remember, when there is no mention they have made, you have got to put deferred taxation effect is ignored. When consider what will happen, we have solved 2 problems, and thereby at this moment we might just see that this particular business combination we will take it up when time is permitting. Now we will take it up onto alongside of this something onto consolidation. Something onto consolidation. So many at times people just have a fear that consolidation is going to take more time and all that. Actually, it is not so. So consolidation is a lollipop question. The reason as why we say it is a lollipop question is that it contains only known adjustments. There is no unknown adjustments you will be having. That means all these matter related to mutual owings, stock reserve, upward, downstream, upstream, and all these computations are frequently done. Within that, some 2021 adjustments alone, you would be having problems in the main examination. There is nothing new that you would be getting. It is like in cost accounting, we used to have standard costing. Many a times, or when I was a student, people used to say standard costing is very difficult, consolidation very difficult. But from my experience was entirely different from what others were telling. Not that I was more intelligent, but I could understand that in fixed overhead, there can only be 5 or 6 variances that you can have: cost, expenditure, volume, capacity, efficiency, and calendar. 6 variances or 5 variances. That is why I said 5 or 6. Not that we are not knowing it about that. Either it could be 5 or 6 maximum. Variable overheads only 3. Labor, you will have 5 or 7 you will be having. Idle time variance, you will have. Sub efficiency, you have. In all these cases, you fix the boundary, and there can be no variance other than this 5 and 6 will be coming. Same way, in consolidation, you will not have an adjustment other than the one that we normally do it in the class. There is no new adjustment that you will be coming, you will be getting. Whereas in other areas, they may combine 2, 3 and bring out some amount of a field that you would be getting, and possibly one adjustment we may ignore, another adjustment we take up. Whereas in consolidation, it is not about a difficult one. It is like your standard costing. If you know the concept, within few minutes you can finish it off. Now, consolidation, on which I will make a brief touching, in the sense as if you are good in this template, you will be working out the fastest in this world. Which one is the fastest animal in this world? Cheetah, ostrich, and all that they will be telling. If you consider human being also as part of animal, I would consider all CA final students are the fastest, provided they follow this template. That means the destination you can reach fastest. We will never have shortcut. We will have shortest cut method. So that is the way we just do everything on superlative basis. Now let's just take up What are those items that we got to have? In consolidation, first thing that we do is that we will identify something called as cutoff. There we will be noting down what is the date of acquisition, date of consolidation. If it were to be during the year, number of months fallen prior to, number of months fallen after, post, percentage of acquisition and non-controlling interest percentage. Everything you got to make a note. There is no computation, let me tell you, it is a number that or data that you are picking up that will enable you to go for rightfully classify the reserves and surplus of. Rightfully classify the reserves and surplus of the subsidiary company, you put it out as classification. Next one, the template is what I will be referring to as charts. It is a God-given chart. Who is a God? People might just tell, sir, God is given. Who is God? God is ICAI. ICAI just given one particular format. I have made a small change and that has become a chart. Then consolidated balance sheet. Majority of the consolidation is hitting only onto the balance sheet that you have cut off classification. What we do in classification, general reserve, profit and loss account, we classify as capital profit and revenue reserve in case of general reserve, revenue profit in the case of profit and loss account. And this chart will enable you to find out goodwill or bargain purchases, non-controlling interest, consolidated reserves and surplus. So here we are in consolidated balance sheet. What is that we will be doing? We will be checking up as whether our calculator is working nice or not. Calculator is working nice or not. What is that we are telling? We will not be telling our balance sheet is agreeing. Balance sheet should agree. Otherwise, we would not have come to see a final. Nowadays, people just don't talk about trial balance, not agreeing, balance sheet, not agreeing and all that. So we will check up every time whether calculator is working nice or not. Now, let's just take up a simple problem. Simple problem means simple problem only. So that I will be taking it up from a source. I will put up that Word document before you and you can make a screenshot and keep for yourself, and then we shall proceed further into this chart and all that. At this moment, I will stop for a moment here. The screen sharing, I will take up that particular input there. A very, very simple problem. Question 2. Question number 2, find out goodwill or capital reserve or bargain purchases, minority interest or non-controlling interest, consolidated reserves and surplus. Date, general reserve, profit and loss account, equity share capital, 1,417, 31,3, 18, 75,000, 99,000, 110,000, 254,000, 400,000. Parent bought 75% in subsidiary for 525,000 on 1/7/17. Where parent reports on the date of consolidation, general reserve at 105,000 and profit and loss account at 300,000. Equity share capital for that particular company being 500,000. Show the extract of consolidated financial statement on 31/3/18. You can take a screenshot. Keep it for yourself. Let us just find out as how we proceed. So the given one is only an example, so you can magnify it. Now I will take up question number 2 screenshot. Cutoff, where we will be noting down the date of acquisition, date of consolidation, how many months had fallen prior to, how many months had fallen after, the percentage of holding and non-controlling interest. 1/7/17, 31/3/18, prior to 3 months, post 9 months, percentage of holding 75 and non-controlling interest 25. Now let us just take up things for classification. First one is general reserve. The general reserve of the subsidiary company on the date of consolidation is 99,000. The opening date and the current year, opening date given in the problem as 75,000. On the current year figure, increase being 24,000. This 24,000 rupees figure can be taken up as 3 months, attributable for the first 3 months and attributable for the last 9 months as pre-acquisition and post-acquisition, 6,000 and 18,000 each. I mean, not each, 6,000 for the period prior to acquisition and 18,000 during the post-acquisition period, resulting from 81,000 rupees being the capital profit and this being revenue reserve. Because it is matter related to general reserve, post-acquisition increase in general reserve, we take it up as revenue reserve. Profit and loss account. Profit and loss account, closing figure is 254,000. There was no utilization from profit and loss account towards any dividend. What they had at the year beginning was 110,000. The current year figure is 144,000, which can be classified as 3 months and 9 months. This being 36,000 on proportionate basis, 108,000 proportionate basis for the post-acquisition period of 9 months, 108,000. 146,000 as capital profit and 108,000 revenue profit. We are expected to classify the reserves and surplus. Post-acquisition increase in general reserve as revenue reserve. Post-acquisition increase in profit and loss account is revenue profit. Have that in your mind. Then the template that we have just developed is only from the institute material. We will call that as chart. We have date of acquisition, date of consolidation, revenue reserve and revenue profit. In institute material, they used to have capital profit, revenue reserve, revenue profit and all that. So we are having one extra column for DOC. So this one they used to call it out as capital profit. You will not have this column revenue reserve and revenue profit you will be having. So that we have changed as DOA, date of acquisition, capital profit, DOC. This is, we have developed it for the purpose of finding out non-controlling interest in one shot. Here we will be noting down equity, share capital, general reserve, profit and loss account, or retained earnings as the case may be. So how do we update this particular place? This updation is done keeping date of acquisition first in our priority. 400,000 is what we will be noting down. General reserve, we will be taking it up at 99,000 and 254,000. First thing we will update in this chart only DOC. And then we will be updating DOA, the same figure of 400,000, what you are finding on the date of consolidation will be there on the date of acquisition. General reserve 81,000 is what we will be noting down. General reserve, we will be noting down 81,000 here and 146,000 here. What existed at the time of controlling acquisition is what we will be noting down there, 81,000 and 146,000. And we will be noting down here 18,000 under revenue reserve, and we will be noting down 108,000 in revenue profit. This is what you would be finding that we are having it. Then we will be affecting the total against each one of those columns. 400,000 plus 81,000 plus 146,000. 627,000 we will be having. Next one, 400,000 plus 99,000 plus 254,000, that comes to 753,000. 18,000 and 108,000. After noting down this, we will be simply noting down their percentage. Here you got to be very careful. That minority percentage of 25% will be noted down only against DOC. DOC is only for NCI. The rest of the places, only the parents holding of 75% will be noted down. Don't ask why it is like that. So I am telling you how fastest you can compute. That is what I am telling you. Net worth against each one of those columns, the figures that you find just above the percentage should be multiplied with the percentage. 627,000 multiplied by 75%. 627,000 multiplied by 75% should give you 4,70,250. 753,000 multiplied by 25% should give you 1,88,250. 18,000 multiplied by 75%, 13,500. 108,000 multiplied by 75% should give you 81,000 here. So the next item that we would like to induct will be investments. What is the value at which investments were made? It is 525,000 is the investment cost. 525,000 to be compared with 470, 250, that comes to 54,750 as goodwill. Goodwill is 74,750. You just get in the least possible time. So I am taking this much of time only for the purpose of explanation. Under examination conditions, you don't have to explain to anybody. You can work fastest. It is not cheetah or ostrich. It is only CA final students. Especially after knowing this template, you will be the fastest, I can tell for sure. Computer will be lagging for a long distance and they will be slow. You will be the fastest. 54,750. After this, what is that we will be doing? we will pick up this SFS information from parents standalone financial statement against RR and RP. We will be updating from parents RR and RP, that is 105,000 and 300,000 we will be updating. 105,000 and 300,000 we will be updating. Correct? Why we are updating? The general reserve of the parent is to be added with the share of parent in the revenue reserve of the subsidiary. The profit and loss account of the parent to which we will be adding the share of the post-acquisition profit of the subsidiary company. So now we can bring out CFS figures. What are the CFS figures? We will pick up this 54,750 towards goodwill. We will pick up this matter and NCA is 188,250. We will add these two and we will arrive at consolidated general reserve 118,500. Similarly, we will be adding these two to arrive at 3,81,000. So when you know general reserve consolidated figure is 118,500 and 3,81,000 towards consolidated P&L account, what is the sum of these two? This is going to be the consolidated reserves and surplus that you have. 118,500 plus 3,81,000, all that put together, that you get as 4,99,500. Correct? 4,99,500 is what you have as consolidated reserves and surplus. Now, the question did carry extract of consolidated balance sheet. I will not be doing extract of consolidated balance sheet. I will do consolidated balance sheet itself with this information. How come? We will do it. Just see as how we are going to do that. So consolidated balance sheet, how we are doing, closely follow. So now let us just have this as parent and this as subsidiary. When they were having equity share capital, general reserve and profit and loss account. So as far as parent is concerned, they are having 500, 300 and 500, 105 and 300. 500, 105,000 and 300,000. Here 400,000. General reserve 99,000. Where from we are picking from here? 254,000. Correct? That's all as far as their equity is concerned. 500 plus 105 plus 300. All that put together, that comes to 905,000. 400 plus 99 plus 254. 753. Then you have, closely follow, investments 525 is the investment that you have taken up here. That should be there on the asset side of the parent. Then other net assets. What could be the other net assets? 3,85,000 dash 753,000. Correct? 905,000 and 753,000. We have constructed a balance sheet now. Why we require extract? This is nothing but SFS. Now you can see CFS in another few minutes. Just see how CFS is coming. It is going to be a magic now. How? See how we will bring out consolidated balance sheet. How we will prepare consolidated balance sheet? Just watch out. How do we prepare? Let us just watch out how we just do that. Now tell me which equity capital will come there in consolidated? Only the parents. Correct? General reserve and profit and loss account, whose item that will come? That we have already worked out. So consolidated reserves and surplus 499,500. From where we are picking up? From here we are picking up. Non-controlling interest NCI will come there. 188,250. Matter over. 750. 7, 8, 11. 11,87,750. Matter over. Liability side over. Just like that you are finishing. Here you will be having goodwill. Goodwill 54,750. Investment will not come there at all. Other net assets you got to simply add 380,000 plus 753,000. How much is that you are having? 11 lakhs 33,000. You are just having. Now it is 11,87,750. Matter over. Are you understanding? That is why I am telling you, fastest animal is not ostrich and cheetah. It is only CA final students. Ostrich and cheetah, despite running fastest, success story will not be there at all. All this animal channel in which they tell only 30% of this cheetah's chase will be successful, 70% it will be unsuccessful. They can be fastest, but only for a limited period of time, only for a limited distance. CA students, these CA final students, they are successful, they will become chartered accountants. Their juniors will be coming, and once again they will be applying this fastest technique, this template, they will be clearing, and success rate is 100%. Follow this template, you just get the quickest the solution, and you feel very happy with that. So with a simple problem, so you might have not even felt that it is a complete problem. Even in the question itself, I've stated as prepare only an extract. Why extract? I will give you consolidation. We have just done that. Are you clear? So what are the steps that we have got to take up? Cut off. This is cut off, noting down and all that. CA foundation students, you tell, read the document, note down. They will do that. The matter which I am just telling you, that this work anybody can do. Classification. Also use intermediate students. That much knowledge only required. Profit prior to incorporation, time ratio, and period, there is sales ratio and all that we would have studied. Now that you don't have all this, you tell them, consider the current year pro rata and add opening and the prior as capital, post as revenue. Then also teach them that you need to have DOA, DOC, RR and RP. You pick up all this information. Even when you are running short of time under examination condition, just in 2 minutes you can finish consolidation. I'm just not telling like building castles in the air or in the space. It's not like that. You can do it. How come? So in the balance sheet of subsidiary company on the date of consolidation, you pick up. You don't have to even classify equity capital, general reserve and P&L account. You pick it up from the subsidiaries balance sheet on the date of consolidation. Apply that percentage 188,250. Straight away you can bring out 188,250. You know, only equity capital of the parent will be there. Just like that, you would have got it. Other non-current, other net assets can simply be summed up. You don't require anybody's help there, except for mutual owings and stock reserve. You just make all this addition. Next one, with these classifications, you can work out the goodwill and plant it here in the next step. So let me tell you, or take inventory. This you can pick it up. This is by calculator itself you can work out. This you need to have a short working, and all other net assets you can update. There is only one thing that you may not know. If you are confident of other items, don't tell others, don't check up with others. Update the balancing figure as consolidated reserves and surplus, and your balance sheet is ready. Who is going to ask any question? Nobody would just get this figure of 499,500 by chance. Only by choice they will be getting. 754, 750 for which you have a goodwill computation. For NCA, you have the computation. For net assets, you have to simply add equity capital is what you got to update from the old balance sheet. Copy paste only. 499,500 is balancing figure. Just like that, you can tell, and this is the answer. So if you do in a detailed fashion 5 minutes, if you do shortcut only 2 minutes. Maybe to make you confident, I'm telling 5 minutes and 2 minutes, you multiply it by 3 times for a bigger size problem. That's it. Now one more problem. Let me just identify the problem before I could just share with you. I will stop sharing now. Oh, see, at this moment it is 4 o'clock. 2 hours gone. Let us just have 10 minutes break before we could just join. Now it is 4:01. Say yesterday we had 2-3 minutes extra. So we will just meet anytime by that point of time. So 4:10, 4:12, 4:13, somewhere that region in which we will meet in 10 minutes time. Thank you. Yes. We are resuming. I will share the screen. Now let us just take up on to a little extra fitting to this particular question, where you just get most of the adjustments there. Now let me just share. It's question number 9. In question number 9, find goodwill, capital reserve, minority interest, non-controlling interest, and consolidated reserves and surplus. Date of consolidation is 31/3/2018. We have equity capital of parent and subsidiary given, general reserve, and profit and loss account given. Parent bought 75% on 1/7/17 for 872,000. Parent received 7,500 as dividend for 16/17 on 1/8/17 and credited that dividend to profit and loss account. Subsidiary earned a PAT rupees 210,000 and it had 160,000 as general reserve by 1/4/17. Subsidiary lost stock costing 20,000 by 1/6/17 and insurance company paid 15,000 on 1/9/17. Subsidiary sold goods costing 40,000 to parent for 50,000. 60% of the goods lying unsold by 31/3/18. Parent sold stock costing 30,000 to subsidiary at 25% profit on sales. 80% of the goods are lying unsold on the date of consolidation. Almost you have pre-acquisition dividend treatment. We have abnormal transaction. We have upstream sales. You have downstream sales. Different percentages of the lot remaining unsold, not 100%. They have not given you the balance sheet, but they have given you the information regarding equity capital, general reserve, and profit and loss account of the parent and the subsidiary. Question number 9. So alongside of the basic information, SFS of parent and subsidiary is readily available as equity share capital, general reserve, profit and loss account. There on the other side, investments. Net assets would mean assets minus liabilities. They given you the equity capital of these two entities, 10 lakhs and 8 lakhs. General reserve 2 lakhs and 1 lakh 80,000. Profit and loss account 4 lakhs and 2 lakh 50,000. $16 lakhs and 12 lakhs 30,000. Investments held by parent 872,000. 16 lakhs there. You do not have that investment, 12 lakh 30,000. This shortcut I was just talking about as how easy and all that. Now I wanted to demonstrate to you. Consolidated financial statement. Huh? Huh? Consolidated financial statement. Imagine that we are running short of time. Though I told you that in 2 minutes time you can finish off, let us just demonstrate as how that is possible. Only the parent's equity capital of 10 lakhs will be continuing there. So you would definitely be having non-controlling interest, but you will not have them in SFS, but you will be having it here. For consolidated general reserve and profit and loss account figure, you can arrive at as balancing figure, or you can arrive at by choice a number. Non-controlling interest similarly. And against this investments, you will have either goodwill or part of reserves and surplus, capital reserve, or bargain purchases. Net assets are simply going to be simple addition here. 728,000 plus 12 lakh 30,000, correct? Normally we are expected to have 19 lakhs and 58,000, but in this case you will not have like that. Because of the fact that you have stock reserve that you got to deduct. So item number 5 and 6, you can easily knock it off. Imagine that you are running short of time. Why would I just do all that exercise when certain things you can do it very fast? Correct. Subsidiary sold goods costing 40,000 to parent for 50,000. You know 10,000 is the profit. 60% of them lying unsold. 40% they sold. That is realized. It is only 60% of 10,000. 6,000 you got to deduct. So 6,000 you got to deduct. Correct. Then parent sold goods costing 30,000 to subsidiary at 25% profit on sale. 25% profit on sale is 33 and 1/3% on cost. 33 and 1/3% on cost is 10,000. At CA final level, you should not be asking, sir, how do you get 25% profit on sale is 33 and 1/3% on cost? You should be knowing it. That when you apply it on 30,000 is 10,000. 10,000, but only 80% of them is unsold. So 8,000 you got to deduct. A simple summation minus these two stock reserve, there is no mutual owings that you have. So straight away, figures can be captured just like that. 728,000 plus 12 lakh 30,000 minus 6,000 minus 8,000. 19 lakhs 44,000. Ready. Figures are ready. We require 3 items. What are the 3 items? Consolidated reserves and surplus, non-controlling interest and goodwill. Out of 3, 2 when you are finding out, other one balancing figure, you can finish the matter and push to the next one. So I am just giving you as how you got to do under emergency scenario. When you board a flight, they will be telling about how you got to adjust yourself in the case of emergency. You can't tell that what is that you are a pessimistic fellow. You can't tell like that. You need to know all the techniques. You can't be just blaming them that you are a pessimistic fellow. No. So be prepared even for the unexpected one. No surprises in this world, no disappointment, and there is no emotions. Now, let's take up on to the normal cutoff classification, etc. So keep these items ready. When you are doing it one after the other, the balance sheet, you can finish it off in no time. Date of acquisition, date of consolidation, prior to, post, percentage, NCI. 75, 25, 3 months, 9 months, 31, 3, 18, 1, 7, 17. Correct. Classification. General reserve. General reserve of subsidiary 180. Opening balance. They've given in the problem opening balance stood by that point of time is 160,000. Current year 20,000. Prior, post. 3 months and 9 months. 5,000 and 15,000. 165,000 capital profit and this being revenue reserve. Profit and loss account. 250,000. Opening and current year. Normally they will give the opening balance, but in this problem, they given current year's earning. Current year's earning. And they have conveyed something about goods costing 20,000, insurance company paid only 15,000. There is an abnormal loss to the extent of 5,000. Though they have given PAT, let us just not look into PAT tax rates and all that. We will simply take it up as net income. 210,000. Add abnormal loss. 5,000. 215,000. Our profit without this abnormal loss would have been 215,000. Then 3 months and 9 months. 53,750. 161,250. What we have added as abnormal loss is matter related to the pre-acquisition period, deduct 5,000. So it is 48,750 and 161,250 revenue profit. The sum of that is once again 210,000. My opening balance will continue to be there as 40,000. So this is after deducting towards dividend. So normally when opening balance is given, we will be deducting it from the opening balance, the dividend that they have declared by the subsidiary company in full. But in this problem, we will not be deducting it because the balancing figure is what we are getting it out as 40,000. Balancing figure would mean it is after deducting towards the pre-acquisition dividend. We will not be deducting it once again. This being the balancing figure. So, therefore, the capital profit is 88,750. 88,750 is capital profit, 161,250 revenue profit. Sum of these two is 250,000 that you have at the top. Is that right? Are you clear? So, we have taken into account the abnormal loss as period prior to, because incident or accident occurred by 1617 prior to the date of acquisition, and we should not get confused with as by what point of time the insurance company paid. Insurance company may pay even 2 years later if there is going to be a suspicion. So you can't take it up as 3 years later that as an income. This is matter related to that period prior to acquisition. And we have just done item number 3, item number 4, item number 5, item number 6, item number 1 also we have just done. So we have got to be very careful with item number 2. Now let us just go for template. Date of acquisition, date of consolidation, revenue reserve, revenue profit. Equity share capital, general reserve and profit and loss account of the subsidiary company. 800,000, 180,000 and 250,000. 800,000, 165,000 and 88,750. Dash dash 15,000 dash and dash 161,250. Now let us effect the total. 800,000 plus 165,000 plus 88,750. 105, that is 10,53,750. Twelve lakhs 30,000, 15,000, 161, 250. Percentage of holding 25 here, 75 in rest of the places. Now let us just find out the net worth. How much is the net worth? 1053,750 into 0.75. 790,313. 1230 into 0.25. So here there is one important thing that we have missed out, one item that I wanted to take it up, that is stock reserve. Stock reserve upstream we have got to take up. Stock reserve upstream we have got to take up, which we have forgotten. So we have just done that stock reserve upstream. Stock sold by subsidiary to the parent, 40,000, 50,000, 10,000, 60%, 6,000 we have got to deduct. We have forgotten to deduct. Please excuse me. 6,000 we have got to deduct and 6,000 we have got to deduct in revenue profit. Downstream we will be deducting it entirely from revenue profit. Please just don't worry about that. 800,000 plus 165,000 plus 88,750. You get 10,53,750. 800 plus 180 plus 250 minus 6. 12,24,000. 15,000 and 155, 250. Percentage of holding 75, 25, 75 and 75. Now let us just find out the net worth. 1053, 750 into 0.75. 790,313, 12,24,000 into 0.25. 3,06,000. 15,000 into 0.75 is 11,250. 155, 250 multiplied by 0.75. That is 11,6437. 1,16,437. We have rounded off in one place. And investments we got it at 8,72,000. Inner column. Pre-acquisition dividend. Pre-acquisition dividend. What is a pre-acquisition dividend? 7,500. We deduct here. The same has got to be deducted because they have taken credit to profit and loss account. 8,64,500. Please just confirm this. 790,313 minus 864,500. 74,187. Please just confirm this number. 8,72,000 minus 7,500. Right. So this is goodwill. Then stock reserve downstream dash 8,000 we got to deduct. Then SFS of parents general reserve and profit and loss account figure 2 lakhs and 4 lakhs. 2 lakhs and 4 lakhs. In the meantime, if you feel that you are showing urgency 74,187, you can take up. 74,187 you can take up. Then non-controlling interest also you can take it up from here. 306,000. 306,000. So you can arrive at as a balancing figure. As I told you, no. Whatever I told you, I wanted to demonstrate. 2018 187 minus 1306,000. So this is going to be 712 187. Even before you could work, you can visualize. Right. Now, CFS figure 74 187 306,000 211,250. Here you got to be very careful. 116,437 minus 15,500 plus 400,000. So it comes to 500,937 plus 211,250. 712,187. Matter over. You should have super control on your work that you are doing. That is why I am telling you, you will reach fastest 100% success rate. Follow this, you will just host all consolidation with comfort with least amount of time. You will never have any feel that it is difficult. That comfort you get only when you follow this format, this particular process. When you do, in no time you can finish it off. First problem to second problem, we demonstrated how it is to be done. Now let us just try a problem where non-controlling interest when it is turning out to be negative, how it is to be reported, that sort of problem we will take it up from our institute study material. I will share that right now. I will stop. So let me share that. Illustration number 19. Attribution of profit bar loss to non-controlling interest. A Limited acquired 70% of B Limited on 1/4/20 exponent at a cost of 10 lakhs. When B Limited had an equity share capital of 10 lakhs, another equity 80,000. In the 4 consecutive years of B Limited, in the 4 consecutive years, B Limited fared badly and suffered losses of 250,000, 400,000, 500,000 and 120,000 respectively. Thereafter, in 2005-06, B Limited experienced turnaround and registered an annual profit of 50,000. In the next 2 years, 2006 and 7 and 7 and 8, B Limited recorded annual profits of 100,000 and 150,000 respectively. Show the non-controlling interest and goodwill at the end of each year for the purpose of consolidation. Assume that the assets are at fair value. So, what we are expected to do when non-controlling interest, when you are applying by applying the percentage on the net worth of the subsidiary on the date of consolidation, if the figure that you have on the date of consolidation turning out to be negative, where the retained earnings had turned out to be negative big enough to consume the equity capital and the general reserve, you would end up with non-controlling interest in the negative. Non-controlling interest in the negative will result in a scenario where you would just get an impression that the money is collectible from somebody else. Please understand that negative figure on the liability side will indicate that this money is collectible from somebody else on the asset side. But why would minority interest would be prepared to pay the money where they did not control the company, and therefore the responsibility of bringing the company in a very great position is fully lying with the parent. for what the parent is doing, why would the subsidiary company take the responsibility of paying any sum of money? So naturally, non-controlling interest will not be prepared to contribute money. So therefore, when it is not recoverable, you cannot put this on the asset side as receivable. Then what is the way out? You can't hide this in any place except to adjust against the consolidated reserves and surplus of the parent. Consolidated reserves and surplus of the parent, against which this negative value of non-controlling interest has got to be adjusted. Not only that, we should do any share of negative profit further attributable to minority interest or non-controlling interest will continue to be adjusted with consolidated reserves and surplus of the parent. And as we know that a low or the lowest for a subsidiary company will not be a permanent one. Subsidiary company will start earning some amount of profit. That point of time, minority interest for the share of profit, they cannot claim until and unless the parent company which absorbed the negative profits of the minority interest or non-controlling interest were all fully recovered. That means non-controlling interest cannot claim this amount of profit immediately. They can do so only when all the negative profits which are absorbed by parent company were all fully recovered. Until such time, the minority interest or non-controlling interest will continue to be reported in the negative. Sorry, will be taken up at nil value, but the same will be adjusted with consolidated reserves and surplus. This is about non-controlling interest in the deficit. Now let us just start doing this problem. I think in one of the examination problems in the recent past, they have asked this question in the main examination. Investments made by parent. Investment made by parent is 10 lakhs. Net worth is 70% of 10 lakhs and 80,000. It comes to 7 lakh and 56,000. They are not mentioned as how non-controlling interest values are taken up. So it is a partial goodwill only. This is goodwill. They are not mentioned about other items. So goodwill is 254,000. Non-controlling interest 30% on 10 lakhs and 80,000. 324,000. This is at what point of time? On 1/4x1. In 4 consecutive years, they suffered losses. And at each point of time, how the same has got to be reported. Now let us just look for a good presentation. Date, revenue profit or revenue profit, share of revenue profit attributable to non-controlling interest, opening, closing, How reported? Absorbed by parent, cumulative figure. X1, X2. Revenue profit first year 250,000 negative. Attributable to non-controlling interest is 30%. 30% of this being 75,000 in the negative. Opening 324,000. So I will put it like this way: 1, 2, 3, 4, 5. 5 is equal to 4 plus 3. 324,000 minus 75,000. 249,000 is the closing. 6. 249,000. Here how it is to be reported? Nil or 5 in case of positive figure. 249 is a positive figure. Absorbed by parent, not applicable, not applicable. X2, X3. Next year it is 400,000. 30% on 400,000, 120,000. Opening 249, 129, 129. Not applicable, not applicable. X3, X4, 500,000. 30%, 150,000, 129,000. Closing will be 21,000 negative. Here is a place nil or 5. In case of negative, in case of positive, in case of negative, nil. So it will be nil. Though it is 21,000, I will report this as 21,000. Loss absorbed by parent 21,000. Cumulatively 21,000. Further loss also same way. X4, X5. 120,000. 30%, 36,000. Opening balance 21,000 negative. Closing balance 57,000. I will continue to report this as nil. Absorbed them by them will be 36,000. Cumulatively 57,000. X5, X6. They have started booking some profit 50,000. 30%, 15,000. 57,000 negative. 42,000 negative. Nil. Here I will absorb 15,000. I will deduct 15,000 from 57,000. This would result in 42,000 cumulative figure. X6, X7. 100,000. 30,000. 42,000 in the negative. 12,000 in the negative and nil. Loss absorbed by the parent 30,000 and 12,000. X7, X8, 150,000, 30%, 45,000. 33,000 positive, 33,000. 12,000 fully recovered and a nil here. Simple only, but you need to know how to present. Some people would be knowing the answer, presentation is a problem. That's it. That's it. So we will get back to consolidation when we have time. We have done 3 problems. Definitely we will get back, because when so many accounting standards are there, it is better that we give equitable distribution. At this stage, I would like to take up on to Ind AS 12. Income taxes. How do we take up income taxes? Many times we will find it difficult as whether it is deferred tax asset or deferred tax liability. So that in few minutes you can finish it off. Taxes are paid based on total income as per Income Tax Act. Income taxes are paid based on the total income as per Income Tax Act, which is not equivalent to accounting income or accounting profit. So when they are not equal, you say that you have differences. These differences can be classified as permanent and temporary. Permanent difference will normally be resulting in entity paying tax which cannot be recovered. Permanent differences will result in extra tax payment cannot be recovered at all. Therefore, you do not have any right. So therefore, ignore this for deferred tax purposes. Will result in extra tax payment, cannot be recovered at all in future. Ignore this for deferred tax purposes. Temporary differences, where you have 2 types of differences: deductible temporary difference, taxable temporary difference. Deductible temporary differences will result in deferred tax asset. Taxable will result in deferred tax liability. deductible temporary difference will result in DTA, the taxable temporary difference will result in deferred tax liability. Right. The journal entry for this being debit profit and loss account, credit deferred tax liability, here debit deferred tax asset, credit profit and loss account. Creation of this journal entry, that is creation of deferred tax asset, is given greater amount of importance. Like you cannot create journal entry for deferred tax asset just like that. So unless you have future profits available against which, when you feel that it can be recovered, you can create it. Otherwise, we are not expected to create this deferred tax asset. You have got to be very careful in creating deferred tax asset. Whereas you should not be just checking up in the case of taxable, because for liability you have to do it. For asset, you can do it only when you have the scope to recover. Right. Now, when a temporary difference will result in deferred tax asset and liability, now let us just see. Already in a very small way, we have just taken up when we did 103, where in the balance sheet, your accounting, say deferred tax asset and liability is not a matter the tax department will be breaking their heads. It's not that. It is only as whether it is a DTA or DDL. So matter is not related to taxation. So associate this only with accounting. So accounting balance sheet and tax balance sheet. Accounting balance sheet and tax balance sheet. So instead of calling it out as a tax balance sheet, we'll call that as tax base. Account base, tax base. Correct. Imagine on account of depreciation, you have the WDV of a particular PPE, say 1000, and this as 900. So accounting base is greater than tax base. Account side is more. Therefore, this will result in either increase in deferred tax liability, because asset side is more. When asset side is more, what is that I should do? I should increase liability, create liability. This is one possibility. There is another possibility also you have. What is that another possibility? Always remember, the world is always having more than one solution. Answer may be same. More than one solution that you have. What is that more than one solution? So ideally, the problem that we have worked out, here I was just talking about as how 36,380 we have worked out. We would have worked out in this fashion 150,000 into 9% into 10 by 12. 50,000 into 9% into 6 by 12. 150,000 into 11.44% into 6 by 12. 350,000 into 11.44% into 4 by 12. 100,000 multiplied by 11.44% into 1 by 12. So that way you get 36,380, or else these numbers you ignore. You work out the consolidated figure of 350,000 in this 150,000 related to specific borrowing, 200,000 related to general borrowing. If you apply in one shot, you get the same number. Your final answer may be same, but there are two different approaches that you have. Same way, when asset side is more, that means what is that you should understand? You create a liability and balance it, but not necessarily always like that. So possibility number one, DTL. Possibility number two, reduce deferred tax asset. Either you increase the liability or reduce the asset. Correct. Next one, it is the opposite. Your asset side is less. Your asset side is less. What are the possibilities that you have? Increase your DTA. Or you reduce your DTL. Correct. When asset is getting reduced, the liability also you reduce. Okay, this is based on assets. Liability is also like that. I have warranty provision. 500 here, 150 here. My liabilities are more. This will result in creation of DTA. Liability is more, so that I increase my asset. Or reduction in deferred tax liability. This is one possibility. Then you have in this fashion, liability side less, creation of DTL or reduction of DTA. Simple. Everything on balance sheet approach, when you do, you would find identifying this DTA and DTL is a simple problem only. Will automatically become a simple problem only. Is that clear? Already we have covered through 103. Not one problem, two problems we have done. Today we have just done 103, 110 and 12. We will revisit this when we find time. Now we will take up on to Ind AS 16. Property, plant and equipment. Property, plant and equipment we will finish off. We will put 38 and 36. What is it we have in the case of 16? Property, plant and equipment. What is that at the intermediate level? We have studied same thing only. Certain items are to be capitalized, certain items should not be capitalized. borrowing cost can be capitalized. After some point of time, that should not be capitalized. You have got to charge a depreciation. How depreciation has got to be charged? Deduct the salvage value. And you can follow WDV method, straight line method, whatever method you like, you can just follow. Change in the method of charging depreciation is only change in the estimate. If your carrying amount is less than the expected salvage value, no further depreciation is to be charged. If the asset is considered to be no longer in use and where it is classified as held for sale, no depreciation is to be charged. You have impairment loss to be accounted. So all these routine factors, what we have studied in intermediate, is what you do have, not big change that you have in this particular case. Not a very big thing that you have. And at the same time, we have problems where impairment loss will also be there. Capitalization of interest will also be there. We need to know certain important things when it comes for capitalization of borrowing cost. Many times institute also went wrong. Sorry to say that in an institute forum. When we tell, it is only with the institute we are telling, no. So with parents also we fight, with children also we fight. That means you cannot conclude that there is no love. Because of love only we will fight. Where there is a love, there will be a fight. So institute had just done, as I told you, that in this particular case, instead of taking up for this 750,000, for 6 months they have multiplied it by 10 months, and because of that the answer is not correct with institute material. Institute is not fortunate to get our answers right. Likewise, institute has got some problem, some prejudice towards a particular item of asset where they say land is not a qualifying asset. And borrowing cost capitalization they do not do for land. They tell that they are not capitalizing, but they will be doing. That is a problem. So let me tell you what is the clarity that we have got to have. I will show you the problem. The clarity that we are bringing out is land is a qualifying asset. Please firstly believe. So on what grounds I am telling? Firstly, to tell that somebody is wrong, no. You cannot just like that blabber. You cannot just like that tell. There should be lot of authority. There will be lot of checking that we will be making. There will be lot of such checking that I've just made. Lot of checking I've just made. Nowhere they have mentioned that land is not a qualifying asset, but institute in their material they have said land is not a qualifying asset, which is wrong. Land is a qualifying asset. I'll tell you why. I have bought a piece of land not to keep that land as an investment property, just like that. I have bought a piece of land to construct a cricket stadium. I cannot put to use immediately upon purchase. I need to cure it. There is a place in Hyderabad by name Uppal. I know that place in Hyderabad, Uppal. The place, when I tell I am just staying in Uppal. Oh, you are staying in Uppal, huh? Very long distance. Somewhere in 88, 89. Today I am hearing that Uppal is a place where we have cricket stadium. I know how Uppal was. Cattle were grazing the place. It is on the way to Ghatkesar. You can reach on either side Hyderabad and Secunderabad. It is an outskirts. Now it has become the nucleus of Hyderabad. The place where I have seen cattle were grazing is a place where we have the cricket stadium there. The land has got to be cured, scaped, where you have to construct a building, that is a stadium, to make it useful. So how land cannot be a non-qualifying asset? It is a qualifying asset. But they have just put land is not a qualifying. Somebody, some intelligence, some wisdom they would have had. I'm not making any criticism, I'm telling you. So I have seen documents on IFRS as well as US GAAP. In all places, they consistently tell that land is a qualifying asset. Only in our institute study material, only from the second edition onwards, it's like that. First edition, they've said land is a qualifying asset. That is the reason as why I'm telling you some wisdom somewhere. So what is the stand that we have got to take? Put a note saying that all pronouncements say that land is a qualifying asset. You put it very clearly. What is the problem? Out of, say, 10, even if institute is taking a prejudicial stand for only one adjustment, you will be losing 1 mark. 99 marks, you are getting it. But internationally, I'm telling you, on a consistent practice, today they may tell, 2 years later, they may bring out an errata saying that land is a qualifying asset. Let me tell you, I am just telling you the truth. Let institute change. Land is a qualifying asset. That is a place, that particular problem that we will be handling. And before that, one particular area where many people find it difficult is exchange transaction. This exchange transaction is a little bit of problem for many. We will just take up 10 minutes time for this and 10 minutes for that illustration number 13. And quickly jump into 38, which is similar to that of 16. And then we will jump into 36 so that we will finish off. 4 plus 6, 10 accounting standards we would have finished off out of 35. And we will revisit. When time is permitting, we will revisit. What is it we will be doing in exchange? Exchange, potent of commercial substance and lacking commercial substance. What is an exchange transaction which is considered to be lacking commercial substance and potent of commercial substance? So lacking commercial substance is old car is exchanged with a new car. Old car and new car will lack commercial substance. It is an exchange which will lack commercial substance. What is that? It is not going to affect your business significantly, substantially, or to a very great extent. See, old car, new car change, old machinery, new machinery change will not be affecting the cash flow. There will not be any significant change in the expected change in the future onto the cash flow. So people might just say, sir, there will be some change in cash flow. In investing activity, you will have to pay for the difference for the new amount, new asset. On account of that exchange program, some difference will result and that you may have to pay. That cash flow I'm not talking about. The entities operating cash flow will not get affected at all. Whereas those exchange programs which are potent of commercial substance impacting operational cash flow. Example, yes, a company which is having a factory requiring a neighboring adjoining land owned by government or owned by some other private party. The company which is requiring for expansion is having, there is a lot of demand for their product, that being manufacturing plant and machinery, but they require adjoining place to expand their activities. The owners of the neighboring land, they are ready to concede some portion of their land in favor of this particular company for a consideration of taking some plant and machinery manufactured by that particular company. So this exchange of machinery to land is likely to have significant increase in the profit. Because of the expansion, there is going to be increase in profit. For the other company also, by conceding the land, they are going to have plant and machinery, they are going to operate the new line of business, and they will be having significant change in the operational cash flow. So likewise, such changes or such exchanges, we will take it up as exchange. These items, we will not take it up as exchange program at all. Then what is that we are expected to do? Potent of commercial substance, there can be two things that you would be having. No cash involved in exchange. Cash is involved in exchange. No cash is involved in exchange is challenging. Cash involved in exchange is less challenging. What is that we are expected to do? When we say as challenging, what is that we are expected to do? Here we will be ending up with two different sub-classification that you would be having. So fair value of asset taken in is greater than the fair value of the asset given up. Next one, fair value of the asset taken in is less than the fair value of the asset given up. Fair value of the asset taken in greater than the fair value of the asset given up. Fair value of the asset taken in is less than the fair value of the asset given up. If that be the case, what are the values at which they are to be recorded? So you got to be very careful. Let us just take up fair value of the asset taken up is 110. Fair value of the asset given is 100. Okay. Carrying amount is 40. Let us just take up the scenario in this particular case, this being 90, taken in is 90. Fair value of the asset given up is 100 and carrying amount is 40. Now, how we are expected to pass journal entry for these two scenarios? When the fair value of the asset taken in is 110, where the fair value of the asset given up is 100. Let us assume, or let us just take up the journal entry in this fashion. Debit PPE taken in, credit PPE given up, credit gain on exchange. Correct? So generally upon purchases you cannot have gain. But in exchange program, one asset is given up, another asset is coming in. Therefore, the gain is matter related to the asset given up, and therefore, upon exchange program, you will definitely be having gain or loss. 99.99% you will have gain or loss. So now tell me, what is the journal entry that we are expected to pass? Journal entry we have passed. We have to give credit to PPE given up at the carrying amount of 40. That is going to be the same in the other case also. PPE GU stands for given up 40. And debit PPE taken in and credit gain on exchange. Now we have got to be very careful. For the first scenario, when the fair value of the asset taken in is greater, imagine that I'm just not finalizing, I'm just telling you with a sort of an imagination on a condition. What we have read out in Ind AS 16, they normally tell when asset is coming in, take it up at fair value. They will always be telling like that way, good things that they will be telling. But only in the classroom, the teacher will be in a position to tell you with caution. Imagine that you are booking it at 110. Fair value of the asset taken in 110. Then people will say 70 is gain on exchange. That is wrong. That is wrong. Because the gain on exchange is only 60. The gain on exchange is only 60. How come the difference between the fair value of the asset given up? If I would have sold, I would have got only 100, not 110. Therefore, gain on exchange can never exceed the difference between the fair value of the asset given up and the carrying amount. Am I right? So, when I say gain on exchange, when I book 70, I am overbooking gain by 10. That means the other 10 is the profit on purchases where I am not supposed to record. Only for sale I can do it. That is the reason as why we will have this done only at 100. So instead of putting it out like this, I would put this scenario in this fashion. Fair value of the asset taken in or fair value of the asset given up, whichever is lower. So instead of telling this principle, I can deal in a particular statement, whichever is lower. That is the way you can tell. But institute standards, they are not telling whichever is lower. I am telling you. Right? Simple only. Correct? Next one, in this particular case, gain on given up could be 60, would mean my fair value of the asset taken in is overbooked at 100. That should not be happening. No. Therefore, let me repeat once again. When you say gain is only the difference, when I take this as 60, I am forced to book the asset that is above the fair value. When the fair value itself is 90, I am booking it at only at 100. That is, I am booking it at 100 when the fair value is only 90. That should not happen. So, once again, the same principle I am adopting it here. What is that? Fair value of the asset taken in or fair value of the asset given up, whichever is lower. This should be the case. When cash is involved, automatically the problem becomes easy to work. So therefore, in this particular case, if I adopt this fair value of the asset taken in or fair value of the asset given up, whichever is lower, the problem is solved. We don't get into problem at all. So here we will be booking it at 90 and gain is booked only to the extent of 50. Is that right? So therefore, challenging portion we have done. When cash is involved, we will have it as less challenging. I will prove that also. Right? How it is less challenging? Let us see that. Are you clear about this when it is challenging? Answer would be yes. The same thing is applicable in the case of Ind AS 38. The same is applicable in the case of Ind AS 38 intangible asset. There also you have exchanges. When it is less challenging, I will take up the same scenario here. What is the same scenario? Taken in 110, given up 100, carrying amount 40. When cash is involved, would mean what is that? Cash will be involved. Given up is 100, taken in value is 110. What will happen to cash? Tell me what will happen to cash. Whether cash will come in or cash will go up. That is, cash will go out. I am taking worth of 110 by giving 100 would mean I got to pay 10 the balance. This will result in outflow of money. In the second case, when it is 90, 140, I have given up 100, I have taken up asset less. Therefore, there is going to be an inflow of cash to the extent of 10. So, automatically the journal entry in the first case would be debit PPE 110, credit another PPE given up 40, credit gain 60, credit cash 10. That is the reason as why I am telling when cash is involved, the exchange problem will be less challenging. This is for this one. What will be the case for this? Debit PPE 90, debit cash 10, credit PPE 40, gain, credit gain 60. So you will never have any problem. Let me tell you. The one and only place is this exchange program on which people will have lot of difficult moments and all that. I hope that this small example will drive home the point very easily. Now, I will take up a problem involving capitalization and all that. Illustration number 13 in PPE, module number 2. I will share at this moment. I will stop sharing the screen. Now I will share the screen. Illustration number 13. This is the place where institute went wrong. Sorry to say that. Not with a lot of enthusiasm, I tell. On 1st of April, Sun Limited purchased some land for 10 million, including legal cost of 1 million. In order to construct a new factory, construction work commenced on 1st of April. X1 Sun Limited incurred the following cost in relation with its construction: preparation and leveling of the land 300,000, purchase of material for the construction 6.08 million in total, employment cost of the construction workers 200,000 per month, overhead costs incurred directly on the construction of the factory 100,000 per month, ongoing overhead costs allocated to the construction project using the company's normal overhead allocation model 50,000 per month, income received during the temporary use of the factory premises as a car park during the construction period 50,000, cost of relocating employees to work at the new factory 300,000, cost of the opening ceremony on 31st of March 150,000. The factory was completed on 30th of November X1, which is considered as a substantial period of time as per Ind AS 23, and production began on 1st of February X2. The overall useful life of the factory building estimated at 40 years from the date of completion. However, it is estimated that the roof will need to be replaced 20 years after the date of completion, and the cost of replacing the roof at the current prices would be 30% of the total cost of the building. At the end of the 40 years period, Sun Limited has a legally enforceable obligation to demolish the factory and restore the site to its original condition. The directors estimate that the cost of demolition is 40 years time based on prices prevailing at that time will be rupees 20 million. An annual risk adjusted discount rate which is appropriate to this project is 8%. The present value of rupee 1 payable in 40 years time at an annual discount rate of 8% is 4.6 paisa. The construction of the factory was partly financed by a loan of 17.5 million taken out on 1st of April X1. The loan was at an annual rate of interest of 6%. Sun Limited received investments income of 100,000 on the temporary investment of the proceeds required. Compute the carrying amount of the factory in the balance sheet of Sun Limited at 31st of March X2. You would explain your treatment of all the amounts referred to in this part in your answer. Could be a potential question in the main examination. So let me just pick up an Excel sheet. So serial number, items, computation, computations, the final amount. Serial number 1. Let us just read the question. They are asking the item by 31st of March X2. They purchased a piece of land 10 million, including legal cost of 1 million. Land including registration cost. Correct? Legal cost and all that. That is considered to be 1 million, 10 million, 100,000. That is 9 million plus 1 million. Amount is I hope that we know that is 10 million is 1 crore. A lakh which will have 5 zeros, 100 lakhs, 1 crore. So it is taken up with greater care. 2. Preparation and leveling of land 300,000. This is given in the problem. No computation. 3. Material 6.08. 6.08. 60 lakhs and 80,000. Employment cost of the construction of workers. Labor. Computation we have got to show. 200,000 from where you got to take up. Construction work started from 1st of May. For how many months we have to take up? The factory was completed in the month of November. So very closely connected with CA Institute. May examination, November examination. So it is 2 lakhs into 7. 7 or 6. May, June, July, August, September, October, November. 7 months. 14 lakhs. 5. Overheads incurred directly on the construction of the factory. So instead of calling it out as that way, I will say direct expenses. Overhead would mean not direct, no. Overhead itself is indirect. One lakh into 7. 7 lakhs. Light number. Then ongoing overhead costs allocated to the construction project using the overhead allocation 50,000 per month. Allocation of overhead not applicable for capitalization. Why? Whether you take up this project or not, you will continue to be incurring that. So 0. We will take every item and we will say that it should be included or not to be included. Even when you are ignoring it, you have to put a note. Income received during the temporary use of the factory premises as a car park, shall that be offered credit? So the cost of construction answer is in the negative. Income incidental not to be credited to asset, but to profit and loss account. Cost of relocating employees. Not applicable for capitalization. 0 and 0. What is the next one? Cost of opening ceremony. Opening ceremony cost. The factory got over by 30th of November, though production they have started only by 1st of February. So you have to capitalize borrowing cost until 30th of November and not post 30th of November. Overall useful life, you should start from that point of time onwards. Then we are expected to take up present value of dismantling. How much is the present cost of dismantling? 40 years later, it will cost them 20 million. 20 million into 0.0. This is 1 million into 2 million into 0.046. 920,000. Before capitalization, $194 lakhs before capitalization. Item number 11. Borrowing cost capitalized. Refer working note number 1. Working note number 1. So 17.5 million they have spent by that point of time itself. They have sent. Borrowing cost. $17.5 million into 6%. Into how many months we shall take up? 1st of April onwards, because land also I am including as qualifying asset. April, May, June, July, August, September, October, November, 8 months into 8 by 12. Borrowing cost is 700,000. Investment income 100,000, which I am crediting. Net borrowing cost 600,000 or 6 lakhs. I think I just not handled the 10, right? Correct only. It is 2 million. Now you will give the breakup. We will provide the breakup. Land will provide this. Correct? Building will provide this minus this. Correct? And how much is the roof costing? They said they have mentioned that 30% cost of the building. Balance building. Balance building is this. So life not applicable for life. In this particular case, roof, how many years of life? 20 years of life. And in this case, 40. Therefore, depreciation for roof per annum, which is equal to roof divided by 20. Depreciation for balance per annum. How much is that? In this case, it is 30 lakhs divided by 20. In this case, 70 lakhs divided by 40. Correct? Then for the year ending, for the period ending 31st of March, depreciation for roof. How many months we have to take up? November end they have finished. You have to charge depreciation from December, January, February and March, 4 months. This divided by 3, 50,000 for 3 months. Sorry, 4 months. Depreciation balance This is the way the sum of the depreciation is 108333. So depreciation for 4 months would be this. WDV would be this minus this. This is the way you got to answer, not by the way institute did. I will calculate, I will just tell you where they've just gone wrong. See, the mistake what they've done is capitalize the interest cost incurred in the 7-month period. Purchase of land would not trigger off capitalization since land is not a qualifying asset is what they are telling. No, they are contradicting their own statement. In fact, the construction started only from May. Correct. Now let's look into how 612.5 they have worked. Where is that computation? 612, huh? How 612.5 they have worked, I will tell you. On 17 lakh, on 17.5 million, the loan that they have taken. How they have taken, instead of taking up for 8 months, they have taken only for 7 months. See, look into that. Lot of contradiction. They have taken on the loan amount, they have taken on the loan amount only for 7 months. That means the loan amount utilized for non-qualifying asset, they have not excluded. If you have borrowed money for financing the land also, you are not expected to take up that 10 million loan also for this purpose. You have taken entire 17.5. If you have just taking up the remaining portion of the assets as per your computation, this is working out only to 94 lakhs, my dear. Out of 194 lakhs of the total expenditure, if you take up the land cost, it is going to cost only 94 lakhs. You should have capitalized only for, the other cost. You are not expected to take up the portion of the loan attributable to non-qualifying asset. When you tell us non-qualifying asset, the loan taken to finance for non-qualifying asset, you should not take up for borrowing cost capitalization. Just by multiplying it by 7 by 12, whatever statement that you are making is not correct. Is that clear? So, the institute itself is contradicting their statement. They could have as well conveyed this way. 1 month they have bought, there was no construction activity. Construction activity started only by 1st of May, and we qualify the borrowing cost only for 7 months, they should have conveyed. But they have given a wrong impression that land is not a qualifying asset. What children will do? Whenever they see a problem with the land, they will say it is not a qualifying asset based on this particular statement. The correct position is land is a qualifying asset. You take it up for all the 8 months because you started booking your loan at that point of time itself. Now look into your computation. Everything is coming to a round numbers. This was the original intent. Somebody else had just taken up some adjustment, some wisdom went wrong. Anyway, let us just leave. This is the truth. And now we have just hitting 6 o'clock, 4 hours of class we have just taken up. So what and all we have just done? We have just done 103. We have revisited 103. 5 problems we have done. Ind AS 12 also we have done. And very important portion, 16 we have done. Consolidation we have done. And exchange programming involving intangible assets also over. The one thing which we could not do, that being impairment, we will take it up tomorrow. Okay. Thank you. And please revise whatever we have just conveyed. Okay. Thank you.